Social Security taxes, they're interesting. So they're determined by what's called provisional income, which is an IRS measurement that will take into account a number of different factors. Your Social Security benefit will actually count towards it. So part of that will count towards it, but then other pieces will count towards it as well. So retirement distributions, traditional ones will count towards it. Other forms of income will count towards this provisional income. Oddly, Roth distributions don't count towards it, which is a huge benefit of Roth that often doesn't get talked about, is the fact that that doesn't trigger any Social Security taxation when you take from Roth monies. But there aren't really any workarounds to drive down this provisional income, loopholes of sorts. But if you didn't have to take as much money from your retirement accounts because you didn't have a state income tax, you potentially wouldn't need to trigger as much Social Security taxes, right? So if you had to take, let's say, 10% less out of your retirement accounts or 5% less out of your retirement accounts because you don't need as much money because you don't have to pay that in the form of taxes at the state level, you're not paying maybe as much in Social Security taxes because your provisional income comes down a little bit. And it's a fairly complex calculation, and I won't dive too much into it, but there is that potential benefit.